Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 221 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about interest rates, and specifically when it comes to something that was recently said by Janet Yellen, who was the previous Fed chair and is now the Secretary of the Treasury. And I think it's really important to understand what she said, the context in which she said it, and how it may impact our financial lives. So stick around for all of that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan that's specific to you and your family's needs, then I can help you do that. Just reach out to me on Twitter, Instagram, Facebook, any of the major social media sites, and let me know that you're interested in financial coaching, and we can set up a financial coaching session or a group of financial coaching sessions that will allow you and I to work together to grow your knowledge of your financial situation, make good financial decisions, and ultimately reach long-term financial freedom, because that is the goal of this show every single day. I want everyone listening to reach long-term financial freedom, and I can help you get there via my financial coaching sessions. Now, we've talked a little bit about interest rates before. We understand interest rates a little bit. We'll recap a lot of exactly why interest rates are set the way they are, how they are determined, and things of the like in today's episode. But over the weekend, an article came out on CNBC, and I think it was worth our review, and it's worth our understanding exactly what's going on. Now, the title of this article was "Higher Interest Rates Would Be Good for the Country, Treasury Secretary Yellen Says." Okay. Now, Janet Yellen is the Treasury Secretary, and she used to be the chair of the Federal Reserve. Now, the Federal Reserve is our central bank in the United States, right? They make all of the monetary policy decisions for the United States, and they're supposed to be an independent governing body, right? They govern our financial system independently without any input from the president or input from Congress. Even though Congress and the president question them quite heavily from time to time, they are not supposed to be heavily swayed by the decisions of the president or Congress or what have you. Now, this statement that Janet Yellen made, right, was in response to being asked questions about Joe Biden's $4 trillion spending proposal, right? Because a lot of people are questioning, why are we trying to spend so much money? Haven't we spent so much money already? What's the deal, right? We want to spend all this money. Isn't inflation already ticking upward? Aren't people already afraid of inflation? Why would we continue to spend money in this way? And in being the Treasury Secretary, she has to answer for those types of things. Okay, so this was during an interview with Bloomberg News. The former Federal Reserve Chair said that the president's plans would total about $400 billion each year, a level of spending she argued was not enough to create inflation over the long run. So she was saying $400 billion a year for 10 years. That is a lot of money, but she says it's a level of spending that was not enough to create any inflation over the long run. All right, she said, if we end up with slightly higher interest rate environments, it would actually be a plus for society's point of view and the Fed's point of view. We've been fighting inflation that's too low and interest rates that are too low for a decade, she said. She added that if the packages help at all to alleviate things, then that is not a bad thing. It is a good thing. And when she says alleviate things, she's talking about when it comes to the job market, when it comes to, people still not fully recovering from the COVID-19 pandemic and the economic shutdown that we had. And so I'm not here to question the spending. I am here to talk about the interest rates, and I'm here to talk about exactly why she would say that interest rates might be good if they're higher. Now, in order for you to understand why that may be a puzzling thing, you need to understand a little better exactly how interest rates work. So first off, an interest rate is a cost of borrowing money, right? Or on the other side of the coin, it is the compensation for the service and risk of lending money. In both cases, it keeps the economy moving by encouraging people to borrow, to lend, and to spend. But prevailing interest rates are always changing, and different types of loans offer different interest rates. If you're a lender, a borrower, or both, it's important you understand the reason for these changes and differences. Now, whenever you go to take out a loan, or whenever a bank is giving a loan, what's being determined there is the riskiness of the borrower. Right? That's why they check things like FICO scores, right? Because they want to know how risky is this borrower? How risky is it to lend money to this individual? Or, when it comes to companies, how risky is it to lend to this company? And based on the riskiness of the loan, we know this because we know that individuals with higher credit scores tend to get lower interest rates on their loans because based on the credit worthiness, right? If you have higher credit worthiness, you should be able to borrow cheaper because it is more likely that you will repay the loan. There's a higher likelihood that you'll repay it. Therefore, they're not going to make you pay as much for that loan. But if your credit score is lower or you are found less credit worthy, then you will have to pay a higher interest rate. Right? That's just naturally how things go. Okay. Now, how are these interest rates determined in the first place? Yes, the more credit worthy, the lower the rate, whatever. But how do you determine base rates? How do you determine what the rate is going to be at any point in time? Well, interest rate levels are a factor of the supply and demand of credit. An increase in the demand for money or credit will raise interest rates, while a decrease in demand for credit will decrease them. Conversely, an increase in the supply of credit will reduce interest rates, while a decrease in the supply of credit will increase them. Okay, so we're in an extremely low interest rate environment right now, right? Historically low interest rate environment. That's why if anybody that's been looking for a home, they've gotten a record low interest rate on their mortgage, and this is simply because the supply of credit is extremely high. Right? The supply of money is extremely high. Now, how is the supply of money so extremely high? Well, the supply of money is high because we've had several stimulus packages, right? And that pushes money into the economy, right? Which circulates money in a very real way, right? And gets money moving through the economy. People are lending, people are borrowing, right? And that increases the supply of credit. Now, the question really is, why do we have such historically low interest rates right now? Because we are in a historically low interest rate environment. Why is that the case? Well, coming out of the Great Recession, 12 years ago, we had extremely low interest rates because during the Great Recession, nobody was lending, right? Nobody was able to borrow money, right? Everything was really illiquid in the markets, right? Money wasn't really flowing through the markets. And given that money wasn't flowing, then what the Federal Reserve did was they decreased the cost of borrowing in a very extreme way. They pumped money into the economy. They pumped money to the banks so they could borrow more and gave them more free rein to borrow, right? And that made people want to get out and actually borrow money and actually spend money on things. And it stimulated the economy in that way. And interest rates stayed low for several years, but we started to tick up interest rates right before the coronavirus pandemic, right? And so when the coronavirus pandemic occurred and there was an economic shutdown that was forced, right? We forced an economic shutdown upon ourselves. Then the federal funds rate dropped precipitously. The Fed decided to drop interest rates very precipitously because the economy was stopped. Right? And people needed to get their hands on money, and money needed to be as available as possible to individuals and businesses. And when that's the case, interest rates are extremely, extremely low. And so that's what we saw in that particular case. So it's no surprise, right, that now we're looking at a low interest rate environment, and people like the Treasury Secretary are talking about the possibility of raising rates in the future and whether or not that would be a bad thing or whether or not that would be a good thing, right? Now, the Fed chair today is Jerome Powell, right? And Fed Chair Powell says it is highly unlikely that the Fed will raise rates this year despite a stronger economy. He said that back in April, right? He's been very stuck on the idea of keeping rates low until the unemployment rate gets back to, near what it was before the pandemic. He said, quote, "I'm in a position to guarantee that the Fed will do everything we can to support the economy for as long as it takes to complete the recovery." And so that really leaves the completion of the recovery determination up to the Fed. And then who knows what other outside voices, whether it be the president or Congress or other political things, are speaking into that. But regardless, right, they hold the keys to interest rates and they hold the keys to monetary policy. And the Fed not only can they impact the interest rates, they can also change the supply of money in the economy. And the way that they've done this, most historically, right, whether it's the Great Recession or whether it is during the coronavirus pandemic, what they have done is they repurchase treasury bonds from the market. Right? And when they do that, what happens? Well, that is basically them printing money, right? You ever hear printing money? That's what we're talking about. They print money in order to pay for those treasury bonds and then bring those treasury bonds onto their balance sheet. And so they're just holding or owning these treasury bonds, but the money for those bonds actually goes back into the market and can be actually lent to other individuals. Borrowers can actually get their hands on that money and it can stimulate the economy. But it increases the amount of money in the economy. And as you increase the amount of money in the economy starts to heat up. The economy starts to go in a very fast way, right? And this is where we start seeing these inflation scares. And we're kind of in a place now where a lot of people are worried about inflation because we pumped a lot of stimulus money into the economy, right? We have all of this bond repurchasing that we've done. There's been, the PPP loans. There's been all types of money that has gone into the economy for free, basically. And when that happens, then the cost of living is naturally going to rise. Because just think about this. Just think about if you have $100, right? We'll use very micro scales here, okay? If you have $100 and something costs $100, right? And so you would be willing to buy that thing for $100. But then the Federal Reserve came out and they said, okay, well, there's $100 in circulation right now. Let's increase that to $105. We're going to add $5 to circulation. Well, then what is the place of business or person who is selling you the thing for $100 going to do? They are going to increase the price of that thing to $105 because now $100, what was once worth $100, is now worth $105, right? But that $105 is less valuable than it was previously. Previously, you could buy more with $105 than you could at the time once the Fed had added money to the economy and increased the prices of goods and services indirectly via the amount of money that they had put into the system, right? So this is what we see when we see inflation. When we see inflation, we see the prices of goods and services rising, not because those things are more valuable now, but because the value of the money that you are using to purchase them is less valuable now. It has gone down. That value of money has gone down. Okay, so we have to keep in mind that even though supply and demand really push the interest rates over time, so does inflation, right? And if inflation gets too high and the prices of goods and services are increasing too rapidly, then what would be the natural course of action? The natural course of action would be to increase interest rates, right? And if you increase interest rates, what's that going to do? That's going to increase the cost of borrowing for both people and corporations. And if you increase the cost of borrowing and you cut all of these bond repurchase programs, you stop doing that, then what will end up happening naturally is that the economy will slow. Now, to what extent? That's the game. That's why the Fed is directed to do what they're supposed to do, and it's their job, right? Because it is a very tricky business in determining how much do we want to try to slow the economy, how much do we increase rates by, how much do we stop this stimulus into the economy, right? And so those are decisions that the Fed has to make, and a lot of people are pushing them to make some of these rate hikes because we're basically at 0% interest rates on the Fed funds rate, okay? And so people are pushing the Fed, hey, we should increase interest rates because if we don't, then we're going to have hyperinflation, which is dangerous, right? Because if you have hyperinflation, that means the cost of goods and services are increasing extremely fast, right? And if that were to be the case, then it's going to be difficult to go out and purchase things as individuals, and it's going to tank the economy ultimately, right? That's what hyperinflation has historically done, right? So that's what we don't want. And so when we talk about what Janet Yellen is saying here when she's talking about maybe, higher interest rates could be a potentially good thing. Well, she's saying that in lieu of the fact that they would pump more money into the economy. And she's saying, I don't think it'll have too big an impact on inflation. But if it does, maybe higher rates aren't that bad. Well, then the question becomes, are higher rates bad? Is a higher interest rate a bad thing? And so let's talk specifically about how interest rates affect the stock market and affect the economy at large. Now, I've told you before, the stock market and the economy are two different things. right? The stock market typically front runs the economy when it comes to its growth and then obviously its decline as well. So typically the stock market is a front runner, but you could also say that the stock market and the economy, they are pretty well indicative of one another over the long term, right? You can see the long-term trends of the economy and how the economy has grown or contracted or whatever it may be, okay? So if you took the federal funds rate, which is the rate that the Federal Reserve sets, it's the rate that we call interest rates ultimately, right? And all interest rates are based on this particular rate. So if you take that rate and you graph it, right? You graph it over time from 1980 all the way to 2021, okay? And you put that graph along with the S&P 500 graph, and you just observe, and you just try to see what occurs. Now, what you see almost exclusively is when interest rates peak, right? When the Fed funds rate peaks, right? That's when the stock market also peaks. The stock market begins to drop after interest rates peak. And then once you see the stock market begin to drop, then interest rates drop as well. And as interest rates stay low, the stock market likes it and the stock market continues to roar upward. Okay, so you see this inverse relationship typically because, right, it is cheaper to borrow if interest rates are lower. And if it's cheaper to borrow, then it's cheaper to grow, right? And companies like cheap growth. They'd like it to be easy to grow, okay? So you can look at that chart and you can see that it's quite obvious that higher interest rates are negative overall for the economy. Now, is it necessary to increase rates over time so that you don't get hyperinflation? Absolutely, right? These interest rates are important when it comes to maintaining some type of homeostasis in the economy and trying to not let anything get overworked or underworked one way or the other, right? Especially in the way that the United States has done it historically. So yes, interest rates do typically have a negative relationship with the economy at large. And that's okay, right? But if our economy hasn't fully recovered, which is what Fed Chair Powell says, right? He says that our economy hasn't fully recovered and that we're still working towards recovery, right? But then you have Janet Yellen saying that, maybe higher interest rates wouldn't be the worst thing because we're going to just keep pumping money into the economy, right? Who's right and who's wrong? Well, I would say that ultimately they both have a little bit of right and they both have a little bit of wrong, okay? I agree with Janet Yellen's idea that, hey, if inflation starts to tick up, yes, you need to increase interest rates. That is just the natural progression of monetary policy in the United States. But I don't necessarily agree with the fact that there should just be continual pumping of money into the economy until we get inflation and then work on tamping that inflation after the fact. Because the inflation that we may see at some point, the money for that inflation may already be in the economy, but it's just not being circulated in the way that the Fed or the Treasury Department thought that it would. Okay, now, what about Fed Chair Powell? Well, he's saying, hey, I don't want to tick up interest rates until the unemployment rate gets back down. Well, the unemployment rate just undeniably has been held higher by the fact that more individuals are being offered this, unemployment insurance that is higher, right? If they're offered this higher unemployment insurance from the federal government and it's more than they would make, right, then they are going to take that. Now, whether or not that speaks to the fact that they should be paid more anyway, not going to get into that. But if it is the case that unemployment is being held up by that particular fact, right, then one of two things needs to occur. Either you need to get rid of that program, right, or, right, if you're going to continue that particular program, then don't have your expectations for unemployment to be so high. Because, quite obviously, right, if people are going to get paid more to work, then people would go to work, right? But people, if they're getting paid more to stay at home, they're going to stay at home. Okay, this is not particularly surprising, right? So even though I think, the chairman has a good idea as far as, hey, we want to take care of our mandate of, maximum employment. Well, maximum employment is only going to come if people are incentivized to actually go to work, right? And if they're not incentivized to go to work, then that will not be the case. So he has to balance these facts out, right? And actually, talk about increasing interest rates in lieu of what's actually going on with other stimulating factors into the economy. Okay, so even though I agree with Yellen that if inflation comes, interest rates should tick higher. I'm kind of agree with, Powell that yes, you do want maximum employment, right? But maybe we are closer to maximum employment than he thinks that we are, right? Based on the fact that a lot of people have remained at home based on those different government programs that we've had, and this stimulus that continues into the economy may be speaking to the fact that we need higher interest rates. But regardless, right, these interest rates are going to impact our lives, and they are going to impact the stock market, right? Like I said, when you plot the Fed funds rate against the S&P 500, right, they run counter to one another typically. Now, the Fed funds rate typically is in response to whatever happens in the S&P 500, right? If the S&P 500 crashes, that means that something extremely negative in the economy occurred, and so you see the Fed funds rate catch up to that later, right? But the Fed funds rate, you see it increasing when we are within a bull market for some period of time, and the Fed funds rate begins to increase because the Fed thinks that the economy is strong enough to deal with higher interest rates at that particular time. But regardless, what you'll see in the stock market is that people will freak out at higher interest rates. They'll freak out at the fact that the Fed thinks that we can deal with a higher interest rate environment because it will slow growth, right? It can slow growth for a lot of companies, and it can decrease their ability to refinance their debt down to lower rates, right? Which again, can be problematic if you get stuck in some debt that you can't repay pretty easily. Okay, cheap money can be good and it can stimulate the economy, but it can also be problematic because too much cheap money, right, is going to leave you in a place where if you can't pay for that cheap money, then there's nowhere lower for you to go when it comes to rates, and it's going to be difficult for you to pay it back without going into some type of financial hardship. So how should you and I think about interest rates, right? Why does this matter to us? I know it matters to the economy at large, but why does this matter to us? Well, it matters to us because we are likely investors in the stock market. I am, right? I don't know if you are, but you probably should be, right? But investors in the stock market don't necessarily like higher rates. But then again, investors in the stock market don't like hyperinflation either, right? Either way, higher rates or an over-inflationary cycle is going to cause the economy and stock prices to contract, right? And that's not what we want. So we want this Goldilocks scenario where it's not too much, not too little, but it's just right, right? We trust the Fed, and we tell the Fed that this is their mandate to keep interest rates just right for the scenario that we are currently dealing with in a particular economy. And if they overshoot on interest rates to the upside, then that means that the economy is going to hurt for some period of time. If they undershoot, that means the economy can get overheated for some period of time, right? But regardless, what we should want is a Goldilocks scenario. And yes, lower interest rates have led to the fact that you have had a stock market boom out of the bottom of the coronavirus pandemic. It's also led to the fact that you had a boom out of the Great Recession, right? Because interest rates stayed low for several years out of the Great Recession. And many would argue rightfully so. And that was primarily under the guidance of Janet Yellen, who was the Fed chair at that particular time, right? So as investors, we don't like rates too high, but we don't like them too low for too long either. Right? So we want the Fed to be able to make good decisions over time. Now, how should we think of them as borrowers, right? If you're taking out a mortgage, of course you want lower interest rates, right? That makes perfect sense. But also, if you're going to buy a home, you're going to take out a mortgage to buy a home. If interest rates are really low, then the demand for homes is going to be extremely high, like we have seen over the past year and a half. And what happens? Housing prices continue to rise, right? Which makes it again, more costly for you because you're going to be buying a more expensive house, but you're going to get that expensive house at a lower interest rate. So initially, when interest rates are lower, it's very good to borrow, right? Because you're like, okay, I can just borrow for this thing and I can pay for it in a cheaper manner, which is fantastic, right? Especially if it's a home, because we don't want to take out a lot of debt. That's not what I teach on this show. But then as time progresses and that abundance of money continues, right, then the price of the objects, the price of the things that you are financing will increase. And when that happens, right, you may still get a low rate, but it's going to be on a higher priced object. So it's really going to even itself out, or maybe not just even itself out. The price will, increase in real terms more than an increase in interest rates would have cost you. So this is a very real balancing act in our minds. Yes, we should care what interest rates are. Yes, we should understand what interest rates are and how they are determined, right? But we also have to understand that they can be beneficial to us in one way or another, and they can be not so beneficial to us, right? Anybody who says they just hate higher interest rates is not taking all scenarios into account. And anybody who says that they just love low interest rates is not taking all scenarios into account. Overall, higher interest rates are bad, lower interest rates are good, right? But anything to the extreme or too long, one way or the other, can be absolutely problematic. And that's what we want to be able to look for. And so that's why I thought it was particularly interesting to talk about the former Fed chair, Janet Yellen's statement over the weekend, right? Because she's saying that higher rates would be good for the economy. Higher rates would be okay for the country. And maybe she's right, right? Maybe she's absolutely right. But it is juxtaposing what the current Fed chair, Jerome Powell, is actually saying. And so it's going to be interesting to see this play out and see exactly how the Fed decides to move in the near future, right? And maybe they don't move in the near future, but if they don't, does that mean things are going to get overheated? Does that mean that things are going to get out of control when it comes to inflation? We don't know. So the bad part is that we have to just sit back, allow them to make the decisions, and then see on the back end whether it positively or negatively affects our lives. Hopefully, they can do things to positively affect our lives, but overall, we can't just trust the fact that they're setting interest rates in a certain way for that to be the thing that we rely on, right? If you're not ready to buy a house, you shouldn't buy a house regardless of the interest rate. If you're not ready to invest heavily because you've got a lot of debt or don't have an emergency fund and interest rates are really low, so you want to invest, you shouldn't invest anyway, right? Don't let interest rates push you in a particular direction. Right? But if you can benefit from interest rates being a certain way for a certain period of time, then by all means, benefit from whatever the macro economy can allow you to benefit from. But again, the macro economy is not always going to be in your favor, right? So just be in the right financial situation to do the things that you need to do that are related to interest rates, and then you'll be better off in the long term. So take advantage of the opportunities that you have. If you can borrow at a low cost, then borrowing at a low cost is okay when it comes to a mortgage, or if you have to refinance some debt downward so you can pay it off quicker, that is exactly what you should do. Or, if you're trying to invest and you can invest more when rates are lower, then that will likely be beneficial to you because your money will be allowed to grow at a higher clip than when interest rates are higher. So that is my spiel on interest rates. That is my spiel on what Janet Yellen said over the weekend. Hopefully this helps you guys to understand interest rates, the Fed funds rate, exactly what the Fed and the Treasury Department are trying to do at any given time. And hopefully, right, interest rates can remain in a range that will be beneficial to us, not lead to hyperinflation, but also not get too high to where we would get to a point where the economy begins to contract again. Hopefully we get a Goldilocks type situation when it comes to interest rates, but don't count on it because there are people making decisions and people are flawed. And so we'll just see as we move forward, but hopefully this helps you guys. And if you have any more questions about interest rates and exactly how they may affect your life, then just reach out to me on any of the social media sites, and that's at MNO with Dylan, and we can set up a financial coaching session, and we can talk through some of these things in your specific situation, talk about some of the debts that you have. Maybe you're wanting to take out a mortgage, maybe you're wanting to pay off debt, maybe you're looking to start investing for the first time, whatever it may be. I can help walk you through different situations in your life. Just reach out to me, message me, Twitter, Instagram, Facebook are the big three that you can get me on, at MNO with Dylan. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. So tune in tomorrow as I continue to bring you guys personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.